Real estate, it can make you incredibly wealthy, or it can be an absolute financial nightmare. And the difference? Well, it often boils down to just one word: risk. So in this explainer, we're going to break down exactly what that means and, more importantly, how you can get a handle on it.
So why is it that one building is a total gold mine and another one, right next door, is just a money pit? It's the question, right? It's what every single investor wants to know. And the answer, you'll find almost always, comes back to understanding and managing risk.
All right, so here's our game plan. First, we'll hit risk versus return. Then, we're going to talk about your investment DNA. After that, we'll dive into the 4 big faces of risk, figure out how to tame them, and finally, wrap up with how to read the financial forecast.
Okay, let's dive right in. First up, risk versus return. This is the fundamental trade-off in pretty much every investment you'll ever make. I mean, think of them as 2 sides of the same coin. You really can't have one without thinking about the other.
So what is risk really? It's kind of interesting because in the world of finance, it's not just about the chance of losing money. It's really all about volatility. How wildly do the returns swing up and down? The bigger those swings, the bigger the risk.
And here's the key thing to remember. Higher risk does not guarantee a higher return. Not at all. What it means is there's the possibility of a higher return. And you, as the investor, demand that possibility as your reward for dealing with all that uncertainty, all that stomach-churning volatility.
And there's actually a name for that reward you're demanding. It's called the risk premium. Just think of it like hazard pay for your money. It's that extra slice of potential profit you need to convince yourself to buy a risky property instead of just parking your cash in something super safe, like a government bond.
All right, before we even start looking at buildings and spreadsheets, we've got to look in the mirror. We need to figure out your investment DNA. Because honestly, understanding your own goals and your own limits is absolutely critical. It's the foundation of any good strategy.
So you have to ask yourself, what are my constraints? Am I in this for a quick flip, or am I playing the long game? That's your investment horizon. How quickly might I need to get my cash back out? That's your liquidity needs. And how much time do I actually have to manage this thing? All these questions, they totally shape what kind of risk is even acceptable for you in the first place.
Okay, so we've looked inward. Now let's look outward at the world of risk itself. We can basically break down all that uncertainty into 4 big categories. The 4 faces of risk. Think of this as your field guide for spotting trouble before it finds you.
Yeah, we're going to start super specific, right at the asset level. Then we'll zoom out to the enterprise level, the people behind it. Then even wider to non-systematic risk and the industry. And finally, the big picture, systematic risk that affects everything. Let's break them down. First up, you've got asset level risk. This is the stuff that's inherent to the specific property itself. We're talking bricks and mortar. Is the roof about to give out? Are your tenants a solid national chain or some fly-by-night operation that could disappear tomorrow? This is the kind of risk you can literally walk around, kick the tires, and inspect for yourself.
And you can see the difference so clearly here, right? On one side, you have a fully occupied building, a big national tenant, a nice fixed-rate loan. That's a much safer bet. On the other, you've got a half-empty building, deferred maintenance, a leaky roof, and a variable rate loan that can just skyrocket. Huge difference in risk.
Okay, next up is enterprise-level risk. And this one isn't about the building at all. It's about the people running the show, the investing entity itself. Does the management team have a fantastic track record with this exact kind of property, or are they kind of new to the game? A really skilled team can navigate choppy waters that would sink an inexperienced one.
All right, number 3 is non-systematic risk. Now we're zooming out a bit. Think of this as industry-specific risk. So for example, maybe a new zoning law gets passed that only impacts commercial real estate. It's not going to tank the entire stock market, but man, it could definitely hurt your portfolio if that's all you own.
And finally, we have systematic risk. This is the big one, the macro stuff. This is the risk that hits everybody and everything. We're talking about major interest rate changes from the Fed, runaway inflation, or a huge natural disaster. You can't really diversify this one away, but you can definitely prepare for it.
Whew, okay, so we've met the 4 faces of risk, the 4 beasts. But here's the good news. You are not helpless. There are absolutely tools and strategies you can use to tame each and every one of them.
So here's your toolkit. For that asset-level risk, your weapon is intense due diligence. For enterprise-level risk, it's all about strong hiring and vetting your team. For that big, scary, systematic risk, it's about careful research and being prepared. And for that non-systematic, industry-specific risk, well, your number one defense is diversification.
And I really want to hammer this point home. Diversification is your key defense against that non-systematic risk. If you own different types of properties in different locations, you're insulating yourself. A big problem in one little corner of the market, say the office sector, doesn't end up sinking your entire ship.
And if you want to get really smart about it, you can look for assets with what's called negative covariance. It's basically a financial seesaw. When one asset's value goes down, the other one tends to go up. Think about it, maybe when the office market is struggling, storage units do really well. Finding those kinds of pairs is a super powerful way to smooth out your returns.
Okay, so you've got a plan to manage risk. Fantastic. But how do you actually measure success? How do you know if you're winning? Well, it all starts with understanding exactly where your returns are coming from.
Your total return on an investment really comes from two different buckets. You've got your periodic income, that's the cash flow, the rent checks you're cashing every month, and then you have capital appreciation. That's the property itself actually becoming more valuable over time. A truly great investment, well, it's going to deliver on both fronts.
But that begs the question, right? What's a good return? How do you even know? The answer is you've got to look at the past. You have to benchmark. Looking at historical data is how you establish realistic expectations for both future returns and, just as importantly, future risk.
So if there's one thing you take away from all this, let it be this. Great investing isn't about avoiding risk altogether. That's impossible. It's about understanding it and managing it intelligently. The goal isn't to find zero-risk investments. The goal is to get paid, and paid well, for the risks you choose to take. That's how you win in the long run.
Wow, we have covered a ton of ground, from your personal investment DNA all the way out to the entire economy. So I'll just leave you with this one question to think about. Now that you know the risks, what's the first question you're going to ask about your next investment?